Right now, as of this very moment, on Wednesday, November 26, 2025, Symbotic Inc. is trading at exactly $77.29 per share. If you are looking at your screen, you are seeing a massive intraday move of positive $21.83, which translates to a staggering 39.36% gain in a single trading session. This is not a glitch. This is not a drill. This is one of those rare market moments where price discovery happens violently and all at once, leaving everyone who was betting on a slowdown completely exposed. When a stock nearly doubles the average annual return of the S&P 500 in just 6 hours of trading, we have to stop and ask the uncomfortable questions. Is this a rational repricing of a future industrial giant, or is this a trap set for retail investors chasing the green candle? The expectation going into this week was heavy with skepticism. If you have been following the narrative around warehouse automation and robotics, the general consensus, the smart money view, was that capital expenditure cycles were tightening. The belief was that major retailers, the companies that Symbotic relies on to buy its massive football field-sized robot hives, were cutting back. Inflationary pressures and high interest rates were supposed to force companies like Walmart and Target to pause their aggressive automation build-outs. The expectation was a miss and lower scenario, where Symbotic would report decent numbers but offer a terrifyingly cautious outlook for 2026. That was the script the bears were reading from. The reality, however, just punched that script in the face. Symbotic didn't just beat earnings, they dismantled the bearish thesis entirely. The curiosity loop here isn't about the revenue beat, it is about where the growth is coming from. Everyone knows about the Walmart deal, but the sudden explosion in price today is actually driven by something the market wasn't pricing incorrectly: the successful pivot into the healthcare supply chain and the acceleration of the Greenbox joint venture. While everyone was worried about grocery margins, Symbotic quietly unlocked a completely new high-margin vertical. Let's look at the immediate market mechanics driving this price action right now. A 39% move on a company with this market cap is rarely just fundamental buying. We are likely witnessing a significant short squeeze. Symbotic has carried a high short interest for months, with skeptics betting that the valuation, often trading at a massive multiple of sales, was unsustainable. When the news hit the wire this morning that revenue for the fourth quarter came in at $618 million, beating the street's estimates, and more importantly, that adjusted EBITDA had swung firmly positive to $49 million, the shorts were caught offside. You are seeing a scramble to cover, which acts like rocket fuel on top of the fundamental buying. If you are holding shares or thinking about buying, you need to understand the texture of this volume. It is not just institutional rebalancing. We are seeing heavy activity across retail platforms. The chatter on forums discussing Robinhood stock trading strategies and SoFi active investing communities is hitting fever pitch. Retail traders are piling in, chasing the momentum, which creates a dangerous but profitable volatility. If you use Interactive Brokers trading platforms, you can see the order flow is skewed heavily toward aggressive market buys, meaning traders aren't even waiting for limit orders to fill. They just want in at any price. This is euphoria, and euphoria is profitable if you respect it, but deadly if you trust it blindly. But let's step back from the ticker tape and look at the company itself. What is Symbotic actually building? It is easy to lump them in with robotics, but that is a lazy comparison. Most warehouse robots are what we call AGVs, or automated guided vehicles, basically smart forklifts that follow a line on the floor. Symbotic is different. They build a system of systems. Imagine a giant cube inside a warehouse, a structure that looks like a Borg cube from Star Trek. Inside this structure, hundreds of autonomous SimBots zoom around at high speeds, not on the floor, but on tracks, handling individual cases of products. They don't just move boxes, they depalletize incoming goods, store them in a high-density buffer, and then repalletize them in the exact order a delivery truck needs for a store route. This is physical AI. It is software that controls the physical world with extreme precision. This distinction is why the stock is reacting the way it is. The earnings report released for fiscal Q4 2025 confirmed that their deployments are speeding up. One of the biggest criticisms of Symbotic in the past was that their systems took too long to install. If it takes 2 years to build the robot hive, the revenue recognition is slow and the customer gets frustrated. The data released today shows they have cracked the code on faster deployment. They are installing these massive systems faster than they were a year ago, which means revenue flows in quicker and margins improve because they're not stuck at a construction site for 24 months. Before we go further, I want to hear from you. This move is polarizing. Some of you probably bought in the 40s and are cheering, while others might be looking to short this spike. Comment below how many shares of Symbotic you currently hold, or if you are waiting for a pullback to enter. I want to see where the sentiment is among serious investors versus the momentum chasers. Now we need to talk about the Greenbox situation, because this is the engine that could drive the stock much higher or send it crashing down if it fails. Greenbox is a joint venture between Symbotic and SoftBank. The idea is brilliant on paper. Warehouse as a service. Instead of a customer paying $50 million up front to buy a Symbotic system, which limits the customer base to giants like Walmart, Greenbox buys the system and then rents the capacity to smaller customers. It brings the cloud computing model to warehouse automation. The update today indicated that Greenbox is starting to gain traction. If this works, it changes Symbotic from a capital-intensive hardware seller into a recurring revenue software powerhouse. The market loves recurring revenue. That is why you see comparisons to Apple stock or Microsoft when analysts talk about ecosystems, even though Symbotic is an industrial player. However, we have to look at the other side of the coin. The contrarian take here is that the valuation is now getting stretched to a point of perfection. Even with today's beat, Symbotic is trading at a forward earnings multiple that would make even Nvidia stock blush. You are paying for growth that hasn't happened yet. The risk is customer concentration. For a long time, Symbotic was essentially a proxy for Walmart's CapEx budget. While the new healthcare customer, Medline, is a massive win that proves the technology works for medical supplies and not just groceries, Walmart still accounts for a terrifyingly large chunk of their backlog. If Walmart sneezes, Symbotic catches a cold. We saw this fear play out last year, and it could happen again. Let's discuss the Medline announcement in more detail, because this is the underreported story of the day. Healthcare supply chains are very different from retail. In retail, if you miss a shipment of paper towels, it's an annoyance. In healthcare, if you miss a shipment of surgical kits, it's a liability. The fact that a major healthcare distributor is trusting Symbotic's AI to handle its inventory is a massive validation of the system's accuracy, 99.9999% accuracy as they claim. This opens up the pharmaceutical and medical device market, which is generally recession-proof. People stop buying flat-screen TVs during a recession, but they don't stop needing heart surgery. This pivot provides a defensive layer to the stock that it didn't have yesterday. If you are an investor who uses Schwab Intelligent Portfolios or relies on Fidelity Wealth Management notes, you might notice that the institutional grade on Symbotic is likely to shift from speculative to growth after this report. The move to profitability, real, adjusted EBITDA profitability, matters for institutional mandates. Many pension funds and large fidelity mutual funds have rules against buying money-losing companies. Now that Symbotic has crossed the threshold into positive EBITDA, a huge pool of capital that was previously locked out is now allowed to buy the stock. This programmatic buying can sustain a rally for weeks after the initial news event. But we must remain grounded. The price is $77.29. Is it worth $77.29? That depends entirely on execution. The backlog is sitting at over $20 billion. That is a massive number. It means they have sold systems that they haven't built yet. The bullish view is that this is guaranteed revenue for the next 5 years. The bearish view is that a backlog is just a list of promises you haven't kept yet. If supply chains for steel or chips tighten up, or if labor shortages hit their installation teams, that backlog becomes a burden. You have to watch the deployment cadence metric like a hawk. If they slow down installations, this stock will give back these gains very quickly. It's also worth comparing this to the broader sector. We're seeing a renaissance in industrial automation. Tesla stock is often discussed for its Optimus robot, but that is general-purpose humanoid robotics.